Ladies and gentlemen, dear friends and guests of MuMAC 2020, the Munich Private Equity and M&A Conference. Welcome to this year virtual 2020 MuMAC from the Hotel Bayerischer Hof in Munich. Everything is different this year. Due to the COVID-19 pandemic, it is not possible to host the MuMAC in the way we are used to. We are missing the fact that this year we cannot meet face-to-face here at the hotel. There will be no Oktoberfest, no after-conference gathering at the Schützenzelt. We hope very much that we can again meet in person next year. We created an alternative way of hosting MuMAC 2020. We welcome our panels in the Bayerischer Hof here, from where we are being streamed live. We thank you that you are participating from your computer wherever you are. I hope some of you are at some beaches in the world we don't know. This year is special to us because it is the 10th anniversary of MuMAC. Looking back 10 years ago, we started the conference with 31 professionals at our offices in Nymphenburger Straße. Today, under special video circumstances, we expect some 800 participants. We are happy to welcome more guests than ever, an all-time high record. Of course, the overwhelming topic this year is the influence of COVID-19 pandemic on the M&A sector in Germany, in Europe, in the world. As a reaction to the pandemic, various restrictions have been put in place, shutdowns in several countries around the world. COVID-19 affected everyone and everything, and therefore also the M&A sector. Comparing the worldwide M&A landscape in March, for example, with the situation in April, it is striking that the number of value of M&A transaction world dropped almost by 30%. In the United States, as an example, the numbers of transactions fell by almost 50%, while the value of transaction went down by almost 80%. Today, we will explore and learn from our experts about the many different effects, good or bad, that the COVID-19 pandemic has and had in the M&A field. We from McDermott, Will & Emery want to express our sincere thank you to our co-sponsors, to PwC, to our conference partners, Aquinex, Alex Partners, DataSite, Helbling, HWF Partners, Schneider Geiwitz Corporate Finance, VTC oder VTC, and our valued supporters Lincoln International and Oaklands. PwC, Alex Partners, and Lincoln, for example, are with us since the second conference back in 2012. Thanks to all of you for your great loyalty. And again, I'm happy to welcome you all. Enjoy the next 2.5 hours live stream from the Bayerischer Hof from Munich. Forgive us if we have any technical issues and bug fixes. We are learning, and we hope to make MuMAC even stronger. Let us go the distance together. And with that, Nick, please introduce our keynote speaker.
Thank you, Christian. Dear audience, I have the pleasure to introduce Dr. Daniel Stelter. Mr. Stelter studied economics at the renowned St. Gallen University and received his doctorate in 1990. He started his career at the Boston Consulting Group, where he, amongst others, was senior partner, managing director, and until 2013, member of the executive committee. Dr. Daniel Stelter is founder of the forum Beyond the Obvious, which specializes in strategy and macroeconomics. He is an expert on economic and financial crises and advises international companies and investors on the challenges of the constantly changing global markets. The Frankfurter Allgemeine Zeitung ranks him 40th in its 2019 Economist ranking of 100 leading economists in Germany with the greatest influence on media, politics, and business. Daniel is a sought-after expert in talk shows, major business media, and at congresses. An expert who brushes against common trends with an unconventional view of opinion. Most importantly, he is producer of a weekly economic podcast, Beyond the Obvious, within the Media Pioneer Group headed by Gabor Steingart. Highly recommendable. My personal prelude to every week. Besides this, Mr. Stelter has established himself as a highly rewarded and well-known author of several non-fiction books with an unbiased view. While he is not guided by political pigeonholing, he focuses on the pressing issues of our time. His latest book, Coronomics, After the Corona Shock, Fresh Start from the Crisis, is, again, highly recommendable. And it refers also to the title of his keynote speech today, which is Coronomics, Impact on the Transactional Landscape. I am thrilled to hear and learn more about Coronomics. We're looking forward to the speech and keynote, and I would invite you all, dear audience, to post any questions for a Q&A session at the end or after the speech via the chat tool. Dr. Daniel Stelter, dear Daniel, welcome. The stage is yours.
Thank you very much. Good morning to everybody. I hope you can hear me. It's working technically. As I said, I'm here in the UK, and the UK, I can tell you, has even worse internet than Germany. You can't believe it, but it's true. So I'm very happy to kick off today's meeting, and thank you very much for the warm introduction. And talking about Corona and talking about Coronomics requires me to go back a bit in the past and talk to time about the time before Corona. And I would like to share with you some slides. What would you expect otherwise from a consultant to do? So I would like to share with you some slides in order to lead you through my view of the world pre-Corona and how Corona is actually speeding up things which are already in the making before Corona. And in order to answer the question in the end, you will see that in my view, as a short summary, the coming decade will be significantly different from the past decades, offering huge opportunities, but clearly, in my view, it's kicking off a change in the economic landscape, which is so fundamental that it's going to be a very different world than the world we've been used to in the past 20 to 30 years. So I have lots of topics, as you can imagine. I would just like to remind all of us that after the financial crisis, we had a very weak recovery. When you're based in Germany, you say, Germany is doing fine. We had a great economic success, no unemployment, everything was fine. Yes, it's true, but even as you will see, even Germany didn't go back to the pre-crisis trend rate. What you see here is just a view on what would have been as the economists tell, what have been the trend continuing without the financial crisis, and then what's happening. And you can see here on the left-hand side, that's the US, hardly the greatest economy ever. The US did manage to get back to pre-crisis trend rate. Europe on the right-hand side is even worse. You see Europe has not managed after the financial crisis to go back to pre-crisis trend. In Italy, as we all know, has major problems already before Corona. You can see here that Italy actually, after 20 years, has a lower GDP than it had in the year 2000. So all this pre-Corona, we can see the financial crisis was not overcome, but the financial crisis was actually extended, as we will see, by monetary policy, but it was not fixed. And even Germany, Europe's engine on the right-hand side, you see that even Germany, although we had the impression of doing good, and although we had the impression of high growth rates, low unemployment, even in Germany, we did not manage to get back to pre-crisis trend rate. And this in spite of unprecedented central bank intervention. You know this, we all know it, we read it every day. The central banks have stepped in 2009 and they started buying up securities, they lowered interest rates. And you see the expectation here, and I specifically took a slide pre-crisis. The expectation was in 2019 and 2020, this to come down. The US Fed has started already to lower its balance sheet, but as you remember, even before Corona, already in the autumn of 2019, the US Fed had to intervene in monetary markets, money markets, in order to stabilize them, and the balance sheet started to grow again. So we had an unprecedented monetary stimulus, and still we have not managed to overcome the great financial crisis. And we had this in spite of having the lowest interest rates for 5,000 years. You see here, it's interesting, there's really data going back 5,000 years saying, okay, what would be the interest rate? You can understand that, 5,000 years back, interest rates were very high because actually it was very risky to give a credit. It was not really, you didn't have any coins or whatever, so it was risky. Then we have a very long period of stable interest rates, as you can see in the 1800s. Then we have, since we've got fiat money, paper money, we had a very high interest rates in the 80s, as some of you might remember, when the Fed was fighting inflation. And since then, we have this downward trend interest rates. Now, the lowest level, and there are studies saying, well, we could expect in the second half of this century to have negative real interest rates on a global scale. To be clear, I don't believe in it. I always say, when people say interest rates are going to be low forever and fall forever, the more people say so, the higher the probability of them being wrong. So, but we will come to it in my outlook. But this is all part of the picture. End of 2019, we already had some issues. And then what we have to see is the cheap money, especially since the financial crisis, is leading to economic problems. And one of the problems is the zombie companies. Zombie companies who don't make enough money to pay the interest, companies who have actually low valuations, and the market says, okay, they're not startups, they're not attractive, but rather we don't expect them to recover. And you see here data from the US, where you see that actually in the US stock market we are reaching 20% of the market being so-called zombie companies. In order to not speak too long this morning, I took out some slides on Europe. In Europe, it's not better, as you can imagine. And what's very interesting actually is that there are studies showing what zombies do, and actually what's the impact of zombies on the economy. And the funny part is, I assume all of you will immediately say, well, zombies are bad because they are going to sell for liquidity and not for profits, which means they are really deflationary, not inflationary. They create overcapacity in the market. So all of you will probably intuitively agree with me, yes, zombies lead to lower inflation. Of course, for example, the ECB says, no, that's not true. But studies say exactly what we would assume is true. Studies say the higher the share of zombies, the lower the inflation rate. Now, you know what's happening. So the central banks are giving money cheaply to commercial banks. Commercial banks have too high debt levels or too high leverage, have problems with the quality of their assets. Therefore, they cannot write down the loans to zombie companies. So they keep on giving these loans. And in the end, this leads to lower inflation rates. As you have lower inflation rates, the central banks then say, oh, we have so low inflation, we have to do more against inflation. So we have money more, make money more, even more cheaper. So central banks are actually leading to the zombification of the economy, although it's going to lead to exactly the contrary of what they actually would like to achieve. And that's a very interesting phenomenon. And so we have now a world, especially in Europe, where banks who in many countries still have a very high share of being zombies, funding companies which are zombies because they cannot afford writing it down, and all of this leads to the zombification of the economy. And this all has nothing to do with Corona. It happened before. Corona is, of course, now going to amplify this trend. And another side aspect is we have, for years already now, the problem of shrinking productivity growth. And it's very simple in an economy. The two drivers of wealth. One driver is how many people are working, and the second driver is what's the productivity of these people. So we know there are fewer people working, especially in the coming decades, because of the shrinking workforce. And if you have lower productivity growth, or even zero productivity growth, like Germany the past few years, this means the pie doesn't get bigger. And if the pie doesn't get any bigger, we get huge conflicts, because then we have distribution conflicts. And for those of you being in Germany, if you listen to the radio, I just did for Deutschlandfunk in the morning, it's always, oh, the rich get richer, or the poor. It's a whole conflict is based here because we don't grow the pie, and this is going to be a big issue going forward. Therefore, just one example, in autumn 2019, the IMF said, oh, we have urgently to do something about the economy. The OECD said we have to do urgently something about the economy. Nothing to do about Corona. You know, some people might have heard that there's something going on in China, but no one spoke about Corona. So it was basically already before Corona, it was clear we have an issue. We didn't deal with the financial crisis. And all this also based in the fact that we also had a fragile financial system. You know this, you know, I know better than everybody else that correlation is not causation. But it's very impressive if you look just at the growth of the balance sheet of the central banks and at the stock market valuations of US stocks. And actually, if you think through how quantitative easing works in the US, quantitative easing as it works in the US, basically buys bonds. And the people who sold the bonds have to put their money somewhere and they put it into the stock market. So the whole program of quantitative easing actually was a program of bringing up valuations in the stock market. And if you do so, creating a wealth effect, and in doing so, driving out the economy. The problem is the rich people don't consume as much as the poor people. So in making the rich richer, and by the way, I have no problem in being a rich richer, but the problem just economic-wise, if you make your rich richer, you don't have the impact on consumption as if you give more money to people in their pocket, as they do currently today, by the way. And you could also say, well, you bring up bubbles, you know, the black, not nice shot, but the black is recessions, and you see we had a dot-com bubble, we all know there was a fundamental change, everyone was euphoric, but don't forget about it, without cheap money, it would not be possible. Then after 9/11, Greenspan wanted to get the economy rolling, cheap money, blowing up the housing bubble. And then now actually you could say we got the everything bubble, also we already some cracks. But the point is, we have the fact that the money is not reaching the real economy, but the financial economy in the past. Also, because of the fact that central banks tend to have a so-called asymmetrical reaction. It's not my wording, it's the wording of the Bank for International Settlements. And they said, well, whenever there's a crisis, the central banks lowered the interest rates, banks lowered the credit standards to keep the system rolling. But they never were able to raise the interest rates up again. We have a long-term downtrend in the interest rates. And you could already say, and you see with the question marks here, it's all pre-corona, you could see, oh, once the interest rate gets to the trend line, we get the next crisis. And this was visible last year in autumn already in the US money market. And then, of course, corona happened. But even without corona, we would have seen a correction this year in the markets. So we have a world where we are asymmetrical correction. We always make money cheaper, below credit standards. This also explains why some people got very rich in the past decade, because if you look, for example, at the list of the richest Americans, you see many people who got rich by investments, so private equity, hedge funds, and whatever, which is nothing else. And I know that many people from this area will be watching me speaking, but it's nothing else than a leverage game. So, you know, if you're always bailed out and you can always refinance at a cheaper rate, of course it boosts asset values, of course it makes people rich who work as leverage. The point of this leverage is, of course, we have increasing debt levels. And also, this, you know, I could continue this chart ends 2017, but we all know globally debt is growing up. And it's going not so much up anymore in the private household sectors, because in many countries, the private households are tapped. There's a ceiling. And just sitting in the UK, I can tell you the private households have very high leverage. We see that corporations have taken on significant debt levels. Keep in mind that in the US, for example, the BBB market was exploding. So compared to many years back, you know, it has more than doubled the share of companies setting a BBB rating. It's still investment grade, but it's not really investment grade. And already before Corona, it was clear that some companies, just think about General Electric, they had officially a BBB, but if you really looked into the data, if you really looked into how good they are doing, you could come up and say, well, it's not BBB anymore. So we had this leverage been going up, and we had the companies, the states in some regions also taking on debt and continuing taking on debt. And therefore, and this is from Deutsche Bank, which I found very interesting, therefore, somehow, financial stability has deteriorated. You know, blue is always a crisis. So we remember the Great Depression and so on and so on. But you see, since 1990, we have a very density. We have a density of financial crisis. So we have a world where the central bank intervenes to bail out people who speculated on credit. And in doing so, gives a strong incentive to speculate even more, to work with higher leverage, to lower your credit standards, laying the foundation for the next crisis, which once again needs an intervention. All this has nothing to do with Corona, but it was a problem already before Corona. And just a quick word on assets and on assets, what you see basically going on. We all have heard about Thomas Piketty. Thomas Piketty is a French economist who travels the world and says we should tax the rich by 90%, and the government should get more and more and more, and he gets more and more popularity. And he only looks at the top part of the chart. This is data. He basically says, well, if you compare wealth to GDP, you see it's going up. So let's take Italy. In 1980, it was about 3 times GDP. Now it's more than 6 times GDP. Look at Germany. It was 2.5 times. Now it's 4 times GDP. So the rich get richer. That's a problem. By the way, for the Germans here, keep in mind this chart. When we talk about the Eurozone later on, you see that the Italians and the French have much more private wealth than the Germans, but it's another point. So what is driving this? It's driven by debt, because you see here, leverage is going up. So we have more debt, and of course, debt is a driver. But that's not understood by people like Piketty. He says debt is neutral. So he says debt is neutral. So for him, if he has an asset with a value of 500, he deducts debt of 200 and says, okay, the net value is 300. And my view is a different one. If you have an asset with 500, if there's no debt available, the net asset value is not 300. You are based in Munich. Just look at real estate prices in Munich. Let's assume everyone in Europe in Munich has to pay for his flat or his house with 50% equity. Would you still have the same prices? Of course not. No one would be able to pay 50 times annual rent for a house if you put in 50% equity. So it's clear that credit drives asset values, and this is a leverage effect. In my normal presentations, I will include a slide of the leverage effect. I assume you all know how leverage works. It's very simple. The leverage effect drives up your returns if you employ a debt. But in doing so, it drives up the values. Just to mention, you buy a flat and you pay not 20,000 euro per square meter, but 30,000 euro per square meter. Not only this flat has got more expensive, but all the flats in the house have gotten more expensive. And all the flats in the street have been gotten more expensive, and all in the whole city have been more expensive, just because you set a new price. And so it's no wonder that we have all this debt going on, but the debt has less and less impact on the real economy. So just take the Eurozone. In the past, I forgot the blue, but I think it was 10 years back, €1 of new debt created 46 cents in new GDP. Now it's down to 38. You see, we have taken more and more debt, but the debt is not ending up in the real economy. And now comes Corona. This is how it looked in March. We know it was the worst downturn ever expected or experienced. We know it was an asymmetrical shock. We had a shock of both sides. We had a shock on the supply side because supply chains didn't work anymore, because products from China didn't come, etc., etc. But it was a huge demand shock, and still is a huge demand shock. And now, of course, we have got a recovery. But the first point is clearly we had here the mother of all recessions, and it's clear this has the potential of getting the world into another Great Depression. Why? Because of all the problems I said before. The economy didn't go good. We had too high debt levels. We have mainly speculated, not invested. And we have not done our homework on issues like the Eurozone and whatsoever. Therefore, it was a fragile economy, and Corona hit it. Then led to the typical reaction. Again, another chart from Deutsche Bank. We had the largest bailout in history. If you did this in constant dollar, and you see never in the history of the world, we had such a reaction by the central banks. It's the largest bailout in history in the G7, and they went really time back. And we had around, you could say, 12, whatever, trillion. I would say in reality, we talk about 20 trillion. So 20 Billionen in dollars being mobilized by governments and central banks worldwide to fight off a Great Depression. And to be very clear, there was no alternative in doing so. It was perfectly right to do it. They really went all in. And you see it here, it's an extraordinary financial stimulus. And we look, for example, at the UK. The UK, the central bank said, we don't bother anymore to go to the private banks to borrow money and then buying, the government and the central banks basically said, instead of going via the private banking sector, We just do it directly. So the Bank of England is funding the government directly. In the US, basically it's happening in practice because the whole supply of new treasury bonds and treasury bills in the past months was brought up by the central bank. And the central bank also said, okay, we buy up junk bonds in the US. So they start buying up stuff for financial stability. I told you we had a huge share of companies being BBB or less. And therefore, it was correct to do so because we would have seen a wave of insolvency just because of difficulties in refinancing. So we've seen the central banks going all in and basically buying whatever is possible. And therefore, it's no wonder that the stock markets are up. It's very clear. Because if you have, money growth going up, it's very clear. What should the money do? You see it in the US with the people speculating on these internet platforms. Because they got a check from the government because they didn't earn money and they couldn't leave their house. So what did they do? Instead of gambling, they bought Tesla and other stuff. So it's fine. The question today is, is it sustainable? I am not the expert on financial market, but I would say it's not. It's at least not if we don't get a true recovery. And this is a very open question. Because, just a word on the recovery, I would say we don't get a V because people always expect this. I always talk about the mirrored root square because, we go down and then you go up, but we don't go up fully, but then we have, after we recover from 80%, it's going to be a long path forward. And if you remember the start of my presentation when I showed you that the economies of the West didn't manage to get back to pre-crisis trend growth from the financial crisis, we will now have the same. We will not return to the pre-crisis trend growth, unfortunately, of the past 10 years. So since the financial crisis and we get into a world with even lower growth rates. And this will have huge implications on what governments are going to do. And we will probably discuss at the end, you will see that issues like the Green Deal and this kind of stuff are going to become very important, not because of climate change, but in order to fight a really big stagnation we might be facing after this shock. Before we come to this, just a quick view on the Eurozone, because it's all very important when we discuss what we have to see and to expect in the coming years. It's very clear that we are honest to ourselves where the Euro stands. So sorry for missing, not correctly translating all of the slides, which I would have done. You see basically what happened with the Eurozone was very simple. The Euro was introduced, everyone got German interest rates. As inflation rates were higher in some countries like Spain, Portugal, France, and so on, real interest rates are very low. What do you do when money is for free? You take on a credit. What do you buy? You buy real estate. When you do, because it's the best asset. What happens? Real estate prices go up. Everyone jumps on the bandwagon. You start building. If you build more, you have to have more people working on construction. Therefore, you have, you recruit people from abroad. If people come and move into your country, you have to build more, etc., etc. This is the Spanish story. So Spain basically had a construction sector as big as the construction sector of France, UK, and Germany together at the height of the boom. So then we got, of course, a crisis because it's not sustainable. And now we have the fact that basically we have two worlds in the Eurozone. We have the northern countries, which are highly competitive, which are export-driven, and we have the south, now stuck with too high wages, low productivity, and no way out. And I like the chart very much from JP Morgan. JP Morgan did a few years back a study and looking into the European Union, and they came up and said, well, a hypothetical currency union of all the countries in the world, beginning with the letter M, so Mauritius, Mexico, Mongolia, whatever comes to mind, would have been better economically than the Eurozone. So the Eurozone is actually diverging, not converging. If you look at the studies from the IMF, it's very clear that in the first few years, when the Euro was announced, until the introduction, there was a convergence. Once the Euro was introduced, we had the first wave of divergence because of the debt-driven boom in the south. And some of you might still remember Sabine Christiansen on TV when they talk about Germany being the sick man of Europe and restructuring, etc., etc. This was due to the high exchange rate. The German mark went to the euro, so we had to regain competitiveness by internal devaluation, which was painful, hard sphere reforms and all that kind of stuff. On the other side, there was a boom. It was the first divergence. Then we did our homework. At the same time, the bubble burst in the south, and since then we had the other divergence. And you've seen it in the beginning. Italy is on a level of economic activity like 20 years back, and this is not going to be sustainable. The problem we have in the world is too much debt. And what could we do about it? And I just would like to quickly summarize the ways before we come to the outlook and to the discussion. We could do austerity. We could do, what's the problem here? I don't love is austerity. Can you save yourself out of debt? No. You can see it in Italy. They are actually, we always criticize Italy from a German perspective. The Italian government has run truly the biggest surplus in the past 10 years. Primary surplus means surplus before interest rates. Much bigger than Germany. Still, they didn't manage to get out of the problem. Why? Because they're lacking economic growth. What you can do as an individual, as a company to save infrastructure works. It doesn't work on the level of a whole economy, and clearly not the whole region like the Eurozone. Growing out, well, would be nice. The problem is that due to our demographic situation, it's not going to work. We will see in Europe now the beginning of a shrinking workforce. And just look at Japan. If you have shrinking workforce, it's not possible to grow yourself out of the problem. It's not going to work, and it's not to be expected. In addition, we saw the productivity growth, which is not sufficient. Productivity growth is not going to be enough. We will see lower growth rates structurally, and therefore growing out of that is not going to work. Back to Mesopotamia is my code word for wealth tax and debt restructuring, because you might remember in Mesopotamia, where writing was invented to document credit contracts. So what you see on the right-hand side of the slide here is a credit contract. So what happens then when you took on a credit, it was noted. When you paid back your credit loan, it was basically you broke this tablet. And in Mesopotamia, they had the so-called UP year. Every 33 years, that was the idea, every 33 years, that all debt is going to be released. So basically, all tablets got broken. And obviously, this was very popular. Therefore, the kings of Mesopotamia started to do it more often. And as you can imagine, if you do it more often, interest rates go up because the creditor wants to back his money earlier before it's lost. And if credit interest rates go up, you all know that you have a problem with that even faster. So at the end, they did it every 3 years. But the point here is, that's an idea, tax the rich or do a debt restructuring, problem solved. The issue here is, it's not very popular. But, just to give you one example, it is discussed. And this is what France discussed. France Strategy is a French think tank. They are supposedly advising the president. And they said already, well, we could have a decree where we actually say the government becomes a partial owner of all land and dwellings in France. We in Germany would say, okay, we've got to make a Zwangshypothek, so kind of a mortgage, but these are the things all discussed pre-corona. You see, it was 2017. So it's not totally to be ruled out, but clearly it's not very popular. And just to also show you some data here, if you look at the debt levels in Europe, it's very interesting. If you, for example, if you believe that the Germans are they have the lowest debt level, that's not true. You see, Italy, for example, the Italian private households have the lowest debt level of the whole Eurozone. It's 41%. That's also one reason, by the way, Italians also are much richer than the others. Germans are not so bad, it's 54, but you see it's not so. German companies have below debt levels, all pre-crisis, 59%. But you see who has higher debt levels. The Netherlands, by the way, the private sector is highly indebted, which is also to do with tax reasons for private households. But you see also that if you look into the total debt level, France has an issue. They've got high debt level on the state level and on the company level. Not so much private household sector, but you see the company level, and also French banks are very active. And therefore, France has the biggest interest in getting into any kind of an agreement where debts on a European level are mutualized. So it could work that you tax the rich. It might even be popular. Still, I'm not sure it's going to happen because it's very difficult to implement. And as you see in the discussion, those, for example, the German politicians who are very keen on taxing the rich in Germany higher, are always opposing when you come up with the idea of, say, tax the Italians more instead of giving them money via the Eurozone rescue fund. Anyhow, inflation obviously would work. Please forgive me for using the picture of a Bundeswehr helicopter. I know they don't fly, but you know the concept I want to make. It's about helicopter money basically being an idea of coming, and you see all the discussion now of modern monetary theory, which is nothing else than say, come on, the government can spend as much as it likes. You see the idea around now with the Green Deal, where Madame Lagarde is already saying, we have to fund the Green Deal, which is nothing else than saying, I will print money in order to pay for the Green Deal. All this is, in my point of view, down the road, not tomorrow, but down the road, laying the foundation for higher inflation rates. I just look for the time because I think I'm a bit too slow. So inflation might be coming. Before we come to the summary, just a bold proposal for the euro, because we have seen what's been going on in Brussels these days. We had the European Reconstruction Fund, because and it was a long time ago. Mr. Macron has already said it years ago. He wants to have a common budget, a common borrowing capability, and fiscal convergence, which means transfer union. You've seen before that actually, in my view, it's not really fair because the fact that the private households in Italy are significantly more wealthy than the Germans. And this has not to do with the distribution of wealth, which is unequal in Germany, but it has also mainly to do with the level of wealth in total, because the Germans overall don't have as much wealth. And so I personally believe that it's not going to be sufficient to have a transfer union, which actually also fits to the feedback from the IMF. The IMF did a study and says, would a transfer union be enough to rescue the euro? And it came up and said, well, the government transfers are never big enough because it has to be private transfer of capital and it's not working. So I'll show you this data. Before already the private wealth in Germany. As you see on the left-hand side, you see Italy, Spain, France. They are far above German levels on the private wealth side. So what could we do? We could have, we could think about, dealing with the Eurozone. We could think about dealing with two issues. One is dealing with debt and one is dealing with the divergent competitiveness. And the summary is very simple. In my view, it's only possible if you do a debt restructuring and a growth program, if it really works. Even better might be a debt restructuring and some euro exits. I doubt that the concept of internal devaluation is going to work, and I doubt that the transfer union is going to work. My proposal in my book is actually the following. It's a bit too complicated, but I basically said, instead of writing a check for the future, you should pool existing debt from all its governments, especially also the German government, on the European level in a one-time effort. And then we all have lower debt levels and we can restart, and this should be refinanced by the ECB. I see the panel is filling and I know that I'm a bit too long, so let's come to my summary. For the next 2 years, I would say we got some tailwinds. We've got the monetary policy is going to be aggressive, aggressive, aggressive. The government spending is going to be aggressive. We will probably, if Mr. Biden gets elected, have a ceasefire in the trade conflict between the US and China, not an end of the war, but I think a ceasefire. And there might be an orderly Brexit if you're lucky. The headwinds is a second corona wave. It's a recession which is difficult to overcome. The continuous globalist equilibrium, and it is orderly Brexit, which means to me there are some opportunities for you to come because there will be ample liquidity and there's going to be a mispricing of some assets which could offer you opportunities for transactions. Medium term, I see additional spending programs, some forms of modern monetary theory of spending programs, helicopter money, the new Green Deal, which is nothing else than a program of destroying existing assets. Because if you tell people you cannot use a car anymore, you destroy their assets. if you tell people you cannot use your oil heating anymore, you just throw an asset, combining it with a demand program of giving people money to spend on something new. This is demand driven, that is going to be helpful for the economy. And we will see redistributive policies, higher taxation, wealth tax, etc. On the other hand, we will have headwinds. We have debt problems continued, we have financial bubbles, we have the issue of central bank policy in itself becoming less effective. The structural change to green technologies is not always good. It's going to be very expensive, as you can see in Germany with the power prices, and we get socialistic tendencies. Overall, this means for me, we will see a secular shift. We will see an end of 40 years of capital winning against labor, of lower interest rates, of low inflation. I would see, also given the demographics, this is going to be the decade where we see a trend change towards inflation. Long term, of course, we got some very good tailwinds. I still believe innovation is great. I still believe that the living standards of the world is going to go up. And we will have lower birth rates also in the crisis regions. And if you have lower birth rates in the crisis regions, it will make the world more peaceful. On the other hand, the Eurozone is not stabilized. I personally believe now that in probably 10 or 15 years, the Netherlands might be the next candidate of exiting. The conflict between China and the US is not stabilized. The demographics, the pension crisis is not resolved. We still have migration pressure in Europe. And the question clearly is, what will be the impact of an aging society on the demand? Basically, we get less demand and therefore probably lower growth rates. This leads me to the point that we might see a discussion around a reset, which is an end to the current monetary order where we have fiat money. I don't know what's coming, but I'm pretty sure we will see an upheaval because the next 5 to 10 years, we will continue using the medicine we used in the past decades, but it's not going to be successful enough, and therefore it's going to cause huge trouble. All of this, in my view, offers huge opportunities for M&A transactions. Short term, it's going to be mispricing of assets, and midterm, it's a fundamental change of the economy, and there will be big winners and big losers. Good for those who are able to pick them in advance. Thank you very much.
Thank you so much, Daniel. Daniel Stelter was a thrilling keynote speech, as thrilling as your book, which I, again, would love to recommend to the audience, Coronomics. And we have a few questions coming in, obviously. As we all grasp your great insights into macroeconomics, the first question, and everybody's looking, obviously, for free advice, where do you see the DAX and the Euro stocks closing end of this year?
I have no clue. To be honest, I think that's, look, I'm not a banker. Bankers have to say this because it's marketing. And, if you want to remember me, I have to say something like 8,000. Because if I say 8,000, you say, oh, this was a very negative remark. If I'm lucky and I'm right, but if I'm right, you will remember me. Otherwise, you will anyhow forget about it. I have no clue. And to be honest, it's not my business. So if my own money, I don't look at the value of the money at the 31st of December, this year, my goal is to have much more money in real terms in 5 years' time. And therefore, I don't do this. If you ask me really about my current strategy, I'm selling calls and buying puts, but that's speculation. I always recommend to everybody not to speculate, but rather have a stable portfolio approach. This gold, cash, real estate, stocks, and then rebalancing whatever once a year, and makes this mostly cost efficient. Don't spend much money on your bank or your banker.
Great, thank you very much. The second question is, when and how will climate distressed assets, as they are currently termed in both Western and Eastern US, exasperate the woes post-corona?
I'm not sure really if I understood the question, to be honest. I would say, let's go on. Look, there's this discussion going on. I say something, and if I didn't answer the question, please correct me. But I would say we have the principal issue, everyone is now moving green. We have the central bank saying, okay, we want to ban brown investments, so we will not buy the bonds of Shell, for example, because it's a brown company, or for coal or whatever. And we only buy from green. Now I could say, well, first step is, given the low interest levels, it doesn't really matter. Down the road, I would say, when everyone is only investing in green and not anymore in brown, I personally would buy brown. But that's more the logic of saying, you know, like with tobacco stocks. If you look at tobacco stocks, they're the best stocks in the US. If you bought them and you reinvested the dividends because they're always low PE level, the PE ratio, they always were a good investment because it was always a worry, oh, there will be you know, something because of cancer, etc., etc. So it was a good investment. I'm not sure it's going to work out this way, but if you don't invest now anymore in drilling, for example, as it's happening, I could even imagine that in a few years' time, oil is going to be more expensive. But let's assume the change to renewables doesn't work as fast as politicians assume. Because you find out that the sun is not always shining and that the wind is not always blowing and you need a backup. We don't have a backup right now for storage of energy of this scale. Then you might find out, oh, there's a higher demand for traditional resources. And if you don't invest in them, prices might go up. So I don't know what's the answer, but for me, the point is, you know, I would not rule out that from a speculative point of view, there might be some opportunities down the road in brown assets.
Interesting. Talking about sort of the development of the European Union, what is your expectation regarding the Brexit impact on this fragile EU environment and the UK itself?
So let's start with UK. Let's go further back and say, let's go to UK itself. And now, as I know, currently for sometimes I'm now spending time here, probably my perspective is a bit changing on the UK. But I would say, in principle, those who said in the beginning it's going to be a disaster for the UK, I would say, well, it might be short term, but we cannot, if you take a perspective of 10 to 15 years, you have to see the UK in theory has the levers to do better than Europe, because my view on Europe is, I have to be very clear, I'm a big fan of the European Union. I'm not such a big fan of the Euro, but I know we have it, but I'm a big fan of the European Union, but I feel that the European Union has not realized what a big loss the UK is, as a voice for freedom, for free market, for a more, I would say, capitalist approach. Because now my fear is that the European Union is more on a way to a managed economy where politicians believe they know better how to save CO2 than the market. And so the UK potentially could have the potential of following a different path, of being more of a liberal economy, very close to Europe, and this could become very attractive in the future. So, but that's a relative perspective. On short term, if we really get a hard Brexit, it's going to be very bad news for everyone involved, for the UK, but also for Europe, especially for Germany, because the UK is a very big export market, mainly for the automotive industry. And if you now have another crisis, I think the European Union is underestimating the economic damage this could have.
Yeah, stunning. And we will see what happens indeed if Netherlands follows or other countries. Difficult times ahead.
Well, Netherlands, to be honest, if you think about the Netherlands and Austria, but I think the Austrians will always most probably stay with the Germans. But the Netherlands clearly, you know, they have a very strict perspective around transfers. And if the European Union is now not careful in how the money is used from the recovery fund, they run the risk of getting a backlash from the Netherlands.
Right. And taking a bit wider view, looking at foreign investors, in particular maybe Chinese investors, how do you evaluate the threat of foreign investors buying European companies struggling because of the current crisis? Is that a threat?
It is a threat. To be honest, I changed my mind here in the past decades of my career. You know, 20 years back, you would have asked me, I would always said, free market, everyone can buy, whoever, you know, acquisition should be free. Like the Brits always said, you know, whoever wants to buy a company, we are free. You know, if the owners want to sell, why not? We sell to everybody. Meanwhile, I think if you really look into what's going on, and in my view, China is not, you know, it's not a competitor. They've got the same opportunities to do the same in China. I would say it's a strategic mistake if we allow certain assets to be sold to China. So I'm not an expert now in robotics, but let's say KUKA, I think KUKA is, you know, if there is a knowledge and the competence is lost to China, it's an issue. And therefore, I think we should have here a more strategic approach. knowing that this is not in line with my overall free market thinking, but we will see the three blocks, China, the US, and Europe, and we will see more protectionism. And in this regard, we have to protect our core technologies and competencies. My fear is then that this protection ends up like with the solar power industry in Germany. You know, the German taxpayer spent more than 80 billion funding this industry, and now it resides in China, and I think that's not how it should work.
In this context, yesterday the IG Metall has announced that they want to set up a private equity fund with the name, curiously, Best Owner Group, BOG, and raise 500 million euro from private investors and in particular the government. So is this, in terms of what you just said, is this the right approach? Do we think that, and I think they in particular want to save the, you know, auto industry, the suppliers in particular, and they think they want to promise, that's what I read, a 10 to 15% return, which is, I think, quite demanding, obviously. So is that then the right approach? I mean, is this the new? Are we heading for the new Norwegian fund in Germany set up by IG Metall?
Okay, let's go back. First of all, I'm a big supporter of the idea of having a sovereign wealth fund. And actually, I proposed, and I will propose in my next book. I will continue proposing it to give every German 25,000 euros in such a fund as a present from the government, and the government should take on a credit on it. So to be very clear, this would be smart. I personally would not invest in a fund managed by the IG Metall because you have a conflict of interest. If you want to make money, this doesn't work. And I think it's a wrong approach, because let's look at the automotive industry. Or let's go a step back. We all agree we've got climate change. We all agree we have to fight climate change. And now let's say we all agree that CO2 is the issue. We just assume it's outright. We have to do it or reduce it. So what do? You have to set a price for CO2. And that's what the European Union has done in the past. That was the certificates. But the mistake was they didn't include the transport sector in these certificates, leading to the fact that now they are unhappy with the CO2 level. And now they start to intervene and say, we have to have harder goals. We have to have, we have to abolish the combustion engine and whatever. So basically, we have now a policy where we are forcing something on an industry which takes more time, and we force them to do it in a faster time. At the same time, we say, oh, we should drive less cars, and we should have smaller cars. So just think it through. If we have in the future half the number of cars on the streets than today, and we have, instead of big cars, we have small cars, basically a battery on wheels. Is this a scenario where the German automotive industry is competitive? No, because given our costs, we are too high. We don't make money with small cars. We make money with big cars. So now, if you are in an automotive industry and someone tells you your market is going to be half the size, and what you are building is not in use anymore, and you compete in the future with countries like China, who aim to produce 50% of the world's electric vehicles, it's very clear that the future is not bright. So what do is you reduce costs. You shift production to other areas where probably the regulation might be more positive, like in the US. And because you can clearly see it's impossible, I doubt it's impossible to have the whole of Europe equipped with electric vehicles in 10 years' time. So basically, you move capacity and you shut down capacity here. So what is now the point of asking the government, who is causing this with the policies, to give you money for a fund to rescue companies which cannot be rescued, given this, at least not at the same size, and then promising 50% return? To me, it just doesn't work out.
Yeah, I feel...
Again, I'm not saying that the automotive industry is sacrosanct. They make huge mistakes, but keep in mind, people working in the public service in Germany make on average 25 euros per hour. People working in restaurants, whatever, make 15. People working in the machinery industry, they make 32. People working in the automotive industry, they make 45 euros per hour. It's one of the best paid, besides lawyers and bankers, whatever, the best paid, jobs in the industry. And now we are shrinking this industry. This has huge implications, and I think we have to have a smarter strategy. And look, and I'm not a technician, but for example, I read now an article of some people who they took a Tesla, they took out the big battery, installed a smaller battery, and installed a small engine on petrol, powering the battery and the electric engine and reducing the CO2 emissions. It's an Austrian company. This sounds to me very smart. It has less CO2 than the electric car, but the German politician says, no, we want to abolish combustion engine. So you see, I'm worried about political implementation. I think we're on the wrong track. And if I can just tell nobody, I would doubt that anybody in this call would really consider spending €1 on an IG Metall managed fund, rescuing a non-rescuable industry and promising 15%. It's a scam.
Yes, I thought it was a hoax when I read it. And I think these are fantastic words to end. Daniel, many thanks indeed. Many thanks for being with us. Many thanks for the keynote. And it's a fantastic word. As I said, I think indeed the public in Germany at least is a bad investor. The private investors do the right thing under free market conditions in competition, and that is the right thing for our conference, private equity. And this leads us to the next panel, which we will prepare now. Daniel, many thanks for being with us. Yeah, great to have you.
Have a nice day. Thank you.
Thank you. Bye.